Hi, my name is Darren Joseph from HEJ.Tax. We're the team that seeks to demystify the sometimes confusing world of international tax. And today I'm in Jakarta, Indonesia, a member of a larger practice called Moores Roland here in the Asia Pacific. And twice a year, we get together as partners from across 18 countries, 40 offices. I'm the chair of the tax working group, and it's an amazing opportunity to get together with my fellow international tax practitioners and share information on emerging trends in the international tax space. Today, I want to talk about a foreign trust as a U.S. immigration tax planning tool. A huge part of our practice is working with U.S. immigration lawyers. For example, Michael Dyke, we have a whole bunch of videos with him where we address concerns from high net worth families moving to the U.S. So from a tax planning point of view, there is an array of tools that we can draw from to help that high net worth family move to the US. Now, most popularly would be a trust. When one of the first things people want to talk about is, hey, can a trust help me? So yes, under some circumstances, setting up a foreign trust can be helpful. Now, let's look at what makes a foreign trust a foreign trust. And now we're looking at code section 301.7701-7. There's the core test and the control test. If it is that a court in the U.S. is able to exercise primary supervision over the administration of a trust, which is a core test, and one or more U.S. persons have the authority to control all substantial decisions of the trust, then you have a domestic trust. So once you pass both, you have a domestic trust. If you fail any of these two tests, the core test and the control test, you have a foreign trust, which is fine, which is what you want, especially when you have assets outside the U.S., which you would as a wealthy family moving from abroad to the U.S. A foreign trust would, when structured well, allow for effective protection of your foreign assets. I'm not talking about taxes right now, just about asset protection. Now let's talk about a grantor trust versus a non-grantor trust. Now, grantor trust is used to describe any trust over which the grantor, otherwise known as the settler, the person who sets it up, retains the power to control or direct the trust income or assets. So when the grantor retains certain powers or benefits in the trust, the income of the trust will be taxable to the grantor rather than the trust. Now, this is important from a tax perspective because as a grantor trust is transparent from an IRS perspective. So the income that accrues within the trust is reflected on your personal tax return. There is no tax benefit. So therefore, most people moving to the US would want to set up a foreign non-grantor trust, not a foreign grantor trust, but a foreign non-grantor trust. The US tax code sees that and has created a whole bunch of rules to ensure that once there is the slightest amount of benefit or influence, that foreign trust would be by default categorized as a foreign grantor trust rather than a foreign non-grantor trust. And here I'm talking about code section 671, 673, 674, 675, 676, and 677. In addition, the foreign trust should have been set up more than 5 years before the family moves to the U.S. This is because of U.S. Code Section 679.84. So it says that a trust settled within 5 years of a person becoming a U.S. person will be treated as a grantor trust. So again, for income tax purposes, that foreign grantor trust is transparent. All the activity, all the income accruing within that trust just flows right through to the personal tax return. So it's as if the trust does not exist from a tax point of view. But it's not that I'm crying down foreign trusts and saying that they're useless. Of course they're useful, but they must be planned well in advance and they must be properly structured so that you will get the benefit that comes ideally with having a foreign non-grantor trust rather than a foreign grantor trust. And even if you do have just a foreign grantor trust, under certain circumstances, that could work too. This is because, generally speaking, pre-immigration trust can be a great tool to avoid U.S. estate and gift tax. Generally speaking, anything contributed towards an appropriately established pre-immigration foreign trust will not be considered part of your estate for U.S. gift and estate tax purposes. And in addition, For those planning to establish permanent residency in the US, this allows your net worth to be reduced so that the US estate tax exemption will not be used on your foreign assets in that foreign trust. In addition, that foreign trust income may also be exempt from state and local taxes, depending on your local law. My name is Darren Joseph from HTG.tax.